Hi everyone, welcome back to my YouTube channel. This is Raz. In this video, we will continue our discussion about itemized deduction, particularly depletion. So if ready, let's start. So we have discussed already a lot about allowable deductions in our previous video discussion, and as sort of recap, we have mentioned that there are 10 items in particular which are provided by our law to be deducted from our gross income. And these items are expenses, interest, taxes, losses, bad debts, depreciation, depletion, charitable contribution, research and development, and pension trust. So in this video, we will discuss about depletion. So before we start our discussion, let us first ask ourselves, what is a depletion? So according to Castaneda Commentaries and Jurisprudence on NIRC, depletion is the exhaustion of natural resources like mines, oil, and gas wells due to production. It is common to mining and timber business. In other words, when we say depletion, this is the exhaustion of natural resources which are considered as wasting assets. The very purpose of exhausting these natural resources is to extract the resources from the earth, such as mines or gas wells for oils. So the exhaustion of these resources is called depletion. These natural resources exhausted by those businesses are called wasting assets. As the physical units representing such resources are extracted and sold, such assets move towards exhaustion. Okay? So, like depreciation, when we say depletion, this is a periodic charge to expense for the extraction or exhaustion of the natural resources. In other words, when we say depletion, this is similar to depreciation in that we allocate the value of the property or the natural resources over its useful life. And this useful life is measured by how many tons or reserves or resources available in that particular area. Okay? So here are some rules for depletion. In case of oil and gas wells or mines, capital invested may be amortized using the cost-depletion method. So this cost-depletion method is the method that is being prescribed by the tax code on how we could compute depletion for oil and gas wells production as well as for mines. So number one, allowance for depletion shall equal to the capital invested, and no further allowance shall be granted. In other words, the total depletion shall equal to the capital investment. This is the cost that the taxpayer has invested into that particular area for depletion or for exhaustion. Okay? And when that capital investment is already deducted from the gross income as in a form of allowance for depletion, no further depletion could be allowed to be deducted from the gross income. Let's have an illustration so that you will understand what this paragraph means. A land containing natural resource was purchased for 110,950,000 pesos. It was estimated that the land, after the exploration and exhaustion of its natural resource, will have a value of 950,000 pesos. It was estimated that natural resources available for exhaustion was 5 million tons. During the year 2018, 500,000 tons were extracted. How much is the deduction for depletion for the year? Okay, before we go to the solution, let us first understand what the problem is all about. So we have this land containing natural resource purchased for 110,950,000. So this land is considered as a wasting asset. Okay, it is a wasting asset because it was purchased solely for exhaustion or for extraction of the natural resources that it contains. So the 110,950,000 is considered to be the capital investment. Okay, and it was said that after the exhaustion and exploration of the natural resources, the land, the wasting asset, will have a value of 950 950,000 pesos. So therefore, when we will deduct the 950,000 pesos or the salvage value of that property from the capital investment, the depletable amount or the amount to be depleted will be equal to 110 million. Okay, so that's 110,950,000 minus 950,000 pesos. So that's 110 million. So that 110 million will be considered as the depletable amount. So we will allocate and amortize that amount like in depreciation. However, we will not use the number of years. We will use the available resources in that particular land or area. Okay, so basically that is the difference between depletion and depreciation. In depreciation, we used the number of years or periods that the property will be useful to the company or the business. But in depletion, we will amortize or deplete the cost using the available resources and not the number of years. Okay? So in this case, we will divide the 110 million by 5 million tons. Okay? So here's the solution. So the depletion for 2018 is computed as follows. So we have the purchase price of the property, that is 910,950,000 pesos, and we will deduct the residual value after the exhaustion of such property, and that is 950,000 pesos. So we will get a depletable amount, which is 110 million. And then we will divide this 110 million by the estimated available resources of 5 million tons. So we will get a depletion rate per ton of 22 pesos. So then it was said also that there were 500,000 tons extracted and sold in the year 2018. So therefore, we will multiply this 22 pesos rate by the resources extracted during the year. Therefore, the depletion for 2018 is 11 million. That's it. That's how you compute depletion. Okay? So you might be asking, this is just an estimated available resource. What if in the future years or in the succeeding years, there will be changes in the estimated available resource? So in that case, if there is a change in the estimated available resource, we will also change the depletion rate per ton prospectively. So for example, in this instance, out of 110 million pesos, 11 million is already depleted or deducted from the gross income of the taxpayer. Therefore, there is only a remaining balance of 99 million pesos as a depletable amount. Okay? So, that is the remaining balance for depletion. What if in the year 2019 there was a change in the estimated available resource? What if from 5 million it becomes 10 million or it becomes 4 million? What are we gonna do? What we will do is we will just adjust the denominator. We will just divide the remaining balance over the remaining estimated available resource. Okay? So, for example, if the new estimated available resource is 10 million, then we will divide the remaining balance by 10 million. That's how easy depletion is. When there's a change in the estimated available resource, you just change the depletion rate prospectively, meaning on the year when there was a change and onwards, not retroactively. Do not do that. Okay, so that is the first rule. We will deplete the entire depletable amount over the estimated available resource. And when this depletable amount or capital investment is already depleted or deducted or amortized and deducted from the gross income, therefore we can no longer deduct anything for depletion because the capital investment is already amortized entirely. So let's go to the second rule. After production in commercial quantities has commenced, intangible exploration and development drilling costs shall be treated as. Okay, what's an intangible exploration and development drilling cost? So aside from the capital investment, aside from the purchase price of the property, of course, there's a need to explore, to drill the ground, to clear the property for exhaustion. Of course, you would need these costs because the natural resources, it's not given or can be seen in the surface of the land. You must look for it. You must search for it. You must drill the ground. You must dig the ground so that you will know where these oil, gas wells, or mines are located, right? So you will have to spend for intangible exploration and development drilling costs. So how this will be treated for taxation? It is said that if incurred for non-producing wells and or mines, when you say non-producing wells and or mines, this means that the digging or drilling or exploration produces nothing, meaning there's nothing in there. It's just a waste of energy, of effort, of money. Okay? If such intangible exploration and development drilling costs produces nothing, okay, the amount spent for that drilling and exploration can be deducted entirely in the year this is incurred. Okay? Whereas if it is incurred for producing wells in or mines, this could be deductible in full amount in the year paid or incurred, or capitalized and amortized at the election of the taxpayer. So again, after the capital investment, after the taxpayer has secured the property for the depletion, okay, so there could be two possible scenarios. Of course, they will explore, they will drill the ground. So the first scenario would be there's a possibility that the drilling, the exploration will have nothing, will produce nothing. Okay, so any cost incurred to that could be deducted in full amount in the year it was incurred. But for those exploration and drilling and development which produces something, which has something, the taxpayer can choose whether to deduct such development and intangible exploration cost in full amount in the year it was incurred, or to capitalize and amortize these costs using the cost-depletion method. Okay? So third rule, any intangible exploration, drilling, and development expenses allowed as deduction in computing taxable income during the year shall not be taken into consideration in computing the adjusted cost basis for the purpose of computing allowable cost depletion. So, for example, if the taxpayer deduct the entire amount in full from its gross income, that amount or that portion already deducted from the gross income could no longer be considered when computing the adjusted cost basis for depletion. But when the taxpayer elects the second option, that is to capitalize and amortize the cost using the cost depletion method, then such amount could be added to the balance of the depletable amount to compute the adjusted rate for depletion. Okay? And I will show you an illustration to better understand what these rules mean. Okay? But before that, here's the illustrative diagram or concept map for the first three rules that we have discussed. So these rules are applicable to mines and gas wells. So for capital investment, it would be depleted using the cost depletion method. And I have already shown you just a while ago a sample problem that computes depletion using the cost depletion method. While for intangible exploration and development cost, these are the subsequent costs, okay, after the taxpayer purchased the property. These are the costs incurred to explore, to develop, to drill the ground. So there will be two possible scenarios. Number one, it could be a non-producing wells and mines. And when that is a non-producing wells or mines, the taxpayer has to deduct that cost outright as an expense. Okay? But if these are a producing wells and mines, the taxpayer has two options. He could outright expense that cost or to capitalize and amortize that cost using the cost depletion method. and we will adjust the depletion rate to accommodate intangible exploration and development cost which the taxpayer opt to capitalize and amortize. Okay? When the taxpayer capitalize and amortize this cost, he will just add the intangible exploration and development cost to the capital investment, to the balance of the depletable amount. And it is said that once the taxpayer elects to outright expense these costs can no longer be capitalized. Okay? Again, he has two options: to outright expense or to capitalize. When he chooses outright expense, he could no longer capitalize that cost for cost depletion method. Okay? Because it would be unfair to the government, right? He already claimed an expense and he will add again to the adjusted cost basis. That's unfair. That's claiming expense twice. Okay, so that's why it's prohibited. So once claimed as an outright expense, it could no longer be capitalized or amortized. So let's have an illustration. ABC Company purchased a land in 2018 containing natural resource for 50 million pesos. It was estimated that the natural resources available for the exhaustion was 5 million tons. We're also given that during 2018, it spent 5 million to explore some areas which turned out to be empty, non-producing wells. After the end of 2018, it extracted a total of 500 tons. In 2019, it also spent another 15 million pesos to explore and develop producing areas. The total estimated reserves are 6 million tons from the original of 5 million tons. At the end of 2019, 1 million tons were extracted. How much is the deduction for depletion each year? So we are asked to compute the depletion for the year 2018 and the year 2019. Okay, let us first analyze this problem. So, in 2018, ABC Company purchased a land containing natural resource for 50 million. So this 50 million pesos is a capital investment. Okay, and this will be depleted. This 50 million pesos will be depleted for 5 million tons, which was the original estimation in the year 2018. Okay, so again, this 5 million tons was the original estimated available resources. In 2018, it also spent 5 million pesos to explore some areas which turned out to be empty. Okay, so we know that this 5 million here will be deducted in full and never capitalized because it's a non-producing well. Also, after the end of 2018, it extracted a total of 5 million tons. So, hold on. We will first solve this first year, 2018. Okay? So, the taxpayer invested 50 million and we will divide this 50 million by 5 million tons. So, we will get 10 pesos depletion rate for each ton. Okay? That is the depletion rate for 2018 before any changes happened in 2019. So, the 10 pesos depletion rate will be multiplied by the total extracted tons at the end of 2018. So, that's 500,000 tons times 10 pesos depletion rate per ton. That is 5 million pesos. That 5 million pesos is the depletion for the year 2018. Okay? Aside from that depletion of 5 million, there is also another expenditure for intangible exploration which turned out to be empty. Therefore, the total deductible amount in 2018 is 10 million pesos. That is 5 million for depletion and 5 million for intangible exploration which turned out to be empty or non-producing. Okay? In 2019, there was another expenditure amounting to 15 million And this time, it is successful because the areas explored and developed were actually producing. And estimated total reserves are now 6 million from the original of 5 million tons. However, as we know, we have already deducted the 500 tons. So therefore, our new tons available is now 5,500,000 tons. Okay, so let me show you the solution for this problem. So solutions for the year 2018. The capital investment was 50 million pesos divided by the estimated reserves available in that time in the year 2018, 5 million tons. Therefore, the depletion rate per ton is 10 pesos. And we will multiply the resources extracted in the year 2018, which is 500,000 tons. So we will have a depletion for 2018 of 5 million pesos. Also, there was an exploration of non-producing wells, and that is 5 million pesos. Therefore, the total deduction for 2018 is 10 million pesos. Okay, that is for the year 2018. Now let's go to the year 2019. So as we know, when the exploration and the development is a success, meaning it is a producing well, the taxpayer has the option to either deduct the entire amount or to capitalize and amortize the cost, the intangible and exploration cost, to the adjusted cost basis for depletion. So we will assume this time that the taxpayer opts to capitalize the exploration cost. Okay, so this will be our solution for the year 2019. So we have here the capital investment of 50 million, and we will deduct the depletion that we have already computed and recorded in the year 2018. Okay, that was 5 million. That was our computation just a while ago. So our remaining balance, which was forwarded in 2019, is 45 million pesos. And we will add the exploration cost incurred in the year 2019, and that was 15 million pesos. So the new adjusted cost basis, or the depletable amount, is now 60 million pesos. Okay, so we will divide this by the estimated reserves. Okay, hold on. Why do we have 5,500,000 depletable reserves? Remember that the new estimated available reserves is 6 million tons, and we have already deducted the 500 tons in 2018. Therefore, we will have the new estimated reserves from 2019 and onwards of 5,500,000. So, as I have said, new estimated reserves was 6 million tons less the previously extracted 500 tons in 2018, so we'll have 5,500,000 tons. So our new depletion rate per ton in 2019 will be 10.91 pesos. Okay, and we will multiply that by the total resources extracted in the year 2019. That is 1 million tons. So our depletion for 2019 is 10,910,000 pesos. That's it. That is how you compute adjusted cost basis for depletion. Here, we have special rules for mines. This does not include oils and gas wells. Okay? So, as regards exploration and development expenditures, in computing taxable income from mining operation, again, this only applicable for mining operations, the taxpayer may, at his option, deduct the entire intangible exploration and development cost as an outright expense. That was the option 1. Okay, or to add the adjusted basis for cost of depletion. That's option 2. So actually, we have already discussed the option 1 and option 2 in our previous illustration. However, there's a slight tweak in this particular rule. So we have already shown how to compute the adjusted cost basis in our previous example in option 2. Okay, that was the option 2. But if the taxpayer elects option 1, in option 1, the taxpayer claimed the entire amount as a deduction from the gross income, right? The amount deductible for exploration and development expenditures shall not exceed 25% of the net income from mining operations, computed without the benefit of any tax incentives under existing laws. So, as I have said a while ago, when it is a producing wells or mines, the taxpayers two option to deduct the entire intangible exploration and development cost from the gross income or to amortize. Now here comes the special rule for mines. When the taxpayer elects option 1, there is a limit. The limit is the deduction for that particular intangible and exploration and development expenditures shall not exceed 25% of the net income from mining operations. The actual exploration and development expenditures minus 25% of the net income from mining shall be carried forward to the succeeding years until fully deducted. So I will show you now a sample problem to illustrate what these two rules mean. Again, these two rules are applicable only for mining operations and not for oils and gas wells. So we have here ABC Company purchased a land in 2018 containing natural resource with the following data. So the ore reserve, this is the estimated ores, was 50 million tons. The ore produced in the prior year, maybe in 2017, was 4 million tons. The ore produced in the current year is 5 million tons. The sales value of the produced this year, meaning this 5 million tons, okay, this 5 million tons has a sales value of 25 million pesos. Okay? And these are the costs for depletion. We have the mine property, the capital investment, which is 5 million pesos. We also have the intangible exploration cost, which is incurred originally in the year of the inception of the operation, and that is 5 million pesos. In total, we have 10 million cost for depletion. Okay? We also have here mining and milling costs, including depletion of 18 million pesos. So again, this 18 million already includes the depletion. We also have here marketing costs, which is 1,600,000, and depreciation of 400,000. And finally, there was an additional exploration cost of 3 million pesos. Okay, hold on. This 3 million is not included yet in the 5 million here. Okay, this is the exploration cost incurred this year, while this exploration cost was incurred last year. Okay, this exploration cost here, this 5 million, is already added for the adjusted cost basis for depletion. So the question here is, how do we account for this 3 million? Okay, this is our problem. This 3 million, the taxpayer has the option whether to deduct this as an expense against the gross income or to capitalize this one as an additional to the cost for depletion. However, this 18 million already included the depletion. The depletion here pertains to the depletion of 10 million pesos. Okay? Again, that 18 million here, which includes depletion, only pertains to the depletion here in the 10 million here, and not including this 3 million. Okay? You get it? So we are now going to account for this 3 million either using option 1 or option 2. So our first solution would be as part of the adjusted cost basis for depletion. So the cost for depletion, we have the mine property, we have the intangible exploration cost, a total of 10 million. Okay, but however, we have already recognized several items or several tons that was 4 million tons extracted years ago. So we will deduct that amount to get the balance. So our depletion for last year was 4 million tons over 50 million tons times 10 million. This 10 million here represents the depletable cost. So the depletion deducted from the previous year's extraction or depletion was 800,000. Therefore, the new balance for this year, this is the balance forwarded this year, is only 9,200,000. Okay? And then we will add the new exploration cost this year, incurred this year, and that is 3 million pesos. Therefore, the adjusted cost basis for depletion is 12,200,000. And we will divide this by the remaining balance of 46 million tons. That is 50 million tons minus 4 million tons to get the depletion rate of 0.2652. And from then, we will multiply the ores produced this year, in the current year, and that is 5 million tons. Okay, so these are the tons extracted or ores produced this year. And the depletion in the current year will be 1,326,000. So this is the second option to capitalize the exploration cost as an addition to the depletable cost, the new adjusted cost basis. Now let's have the option 1. What if the taxpayer opts to deduct this exploration cost, this 3 million, from its gross income? Let's see if there's a difference. So this is the option 1. So in option 1, we will compute the net income. So we have the sales value of ore produced. Again, as I have said just a while ago, this 25 million is the sales value of the 5 million tons produced this year. Okay? So less the production and selling cost, we have the mining and milling cost of 18 million. We have the marketing cost. We have the depreciation, that is 400,000 pesos. So we will get a net income from operation of 5 million pesos. Hold on. Recall that this 18 million already includes the depletion. Okay? But again, as I have said just a while ago, that 18 million only includes the depletion for the original capital investment and the intangible exploration cost, which was a total of 10 million pesos. This mining and milling cost, which includes depletion, do not include the new intangible exploration cost of 3 million. Again, this 18 million here did not include the 3 million additional cost. Okay? So, we will multiply the net income from operation by 25%. That is 1,250,000 pesos. This is the amount to be deducted as exploration cost, not as depletion. Again, since in option 1, the taxpayer elects to deduct the intangible exploration and development cost as a deduction itself, not as part of depletion. So this 1,250,000 will be deducted from 5 million pesos. Okay? So you might be asking, what will happen to the 3 million pesos intangible exploration and development cost incurred this year? So out of 3 million costs, we can only deduct 1,250,000 pesos from the 5 million. That is a limit. So you might be asking, how about the excess? How about the other 1,750,000 pesos? Well, that excess amount, which is not allowed to be deducted this year, can be deducted in those succeeding years. Meaning, we still have to deduct the 1,750,000 next year. If the 25% limit next year is still not enough to cover the entire 1,750,000, then again for the next years and so on until the entire 3 million is fully absorbed by the income of this mining operation. So again, we will compare with the actual current exploration cost, which is 3 million. Therefore, the deductible amount is 1,250,000, and the exploration cost chargeable in the succeeding years, we still have 1,750,000. This is considered as a deferred cost. Okay, so that's it. Again, this exploration cost of 1,250,000 could not be part of the depletion because the taxpayer opts to deduct this from the gross income and not as part of the adjusted cost basis for depletion. And in this particular case, the 1,750,000 shall be deducted in the succeeding years. So if in succeeding years there is only a limited income and then 25% limit could not absorb the entire 1,750,000, then again in the succeeding years it could be deducted as well until such time that the entire 3 million is fully absorbed. Okay, and also remember, this particular rule applies only to mining and not for oil and gas wells. Okay, meaning to say, the oil and gas wells, when they choose to deduct the intangible and exploration cost from their gross income, they can deduct the entire intangible and exploration cost without the limit of 25%. The 25% limit applies only to mining operations. Okay, so I hope you learned a lot from this video, and I really hope that you would watch the other videos we have about itemized deduction. And if you like this video, give me a thumbs up, hit subscribe, and click the notification bell so you'll be notified whenever I will upload new videos. Thank you so much for watching. Bye bye.